Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about WEICHAI Power Co. Limited annual report. WEICHAI Power Co. Limited is a leading company in the automobile and equipment manufacturing industry with operations in China and internationally. The company operates through four main segments: engines, automobiles and auto parts, agricultural equipment, and intelligent logistics. The engine segment offers a wide range of products including engines for trucks, buses, construction machinery, and agricultural tractors and harvesters. WEICHAI Power also provides energy and power solutions such as generator sets and industrial power products, transmission and PTO products, axles for various vehicles and machineries, and hydraulic systems. In addition to its engine and equipment manufacturing business, WEICHAI Power also offers new energy products including pure electric drive, hybrid power, and range extender systems. The company's commercial vehicle and auto parts segment provides a variety of products such as parts, oil, and remanufactured goods. Furthermore, WEICHAI Power engages in forklift production, warehouse technology, and supply chain solution services. Its industrial truck and services materials handling business offers a range of solutions to meet the needs of various industries. The company's diverse product offerings are sold under several brands including WEICHAI Power Engine, Fast Gear Transmission, Hand Axle, Shanxi Automobile Heavy Truck, and WEICHAI Lovell Smart Agriculture. Overall, WEICHAI Power Co., Limited is a comprehensive provider of engines, equipment, and services to various industries, with a strong presence in China and international markets. WEICHAI Power Co., Limited, market capitalization of $254 billion, is significantly larger than the average industry peer of roughly $33 billion. This shows that WEICHAI Power Co., Limited holds a significant advantage in their industry. WEICHAI Power Co., Limited trades at a higher price-to-earnings ratio of 20 times and a higher price-to-book ratio of 2.37 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 64% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 2.71%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified from the extracted summaries. On the growth side, the automobile and automobile components segment saw a significant increase in revenue, with a 70.8% rise to $64.02 billion. The intelligent logistics segment also experienced a substantial growth, with a 100.1% increase to $91.13 billion. Other notable drivers of revenue growth include the intelligent equipment segment, which grew by 61.8%, and the powertrain, complete vehicles and machines and key components segment, which saw a 12.6% increase. The launch of new products, such as the large harvester with increased throughput, also contributed to revenue growth. Additionally, the development of differentiated product portfolios and the influence of policy on the heavy-duty truck industry through trade-in subsidy programs were significant drivers of revenue growth. Furthermore, the increased demand for engines used in power generation and the year-on-year increase in domestic vehicle sales also contributed to revenue growth. On the decline side, the agricultural equipment segment saw a decrease in revenue, with a 14.5% drop to $13.32 billion. The automobile engine segment experienced a 1.3% decline, while the industrial trucks and services segment decreased by 3.9%. The transition of the agricultural equipment industry towards high-efficiency, intelligent, green, and low-carbon products also contributed to revenue decline in this segment. The net income of the company experienced a decline, with a decrease of -4.7% and approximately -4.2%. This indicates a reduction in profitability over the period under review. The profit margins also underwent a change, with a notable decrease in operating and net profit margins. The operating profit margin dropped from 8.1% to 6.9%, while the net profit margin decreased from 6.6% to 5.9%. Furthermore, the gross operating margin in the domestic segment saw a decline of 2.2%. The reasons behind these changes are not explicitly stated in the provided text. However, it can be inferred that various factors such as market conditions, competition, and operational inefficiencies may have contributed to the decrease in net income and profit margins. The company's financial performance is a testament to its ability to generate significant positive operating cash flow. The data presented across various pages of the report confirms this trend. On page 11, the total operating cash flow stands at $16,213,910,290.01, indicating a substantial inflow of funds into the business. Furthermore, on page 12, the segment results reveal an even higher operating cash flow of $17,114,747,146.49, reinforcing the notion that the company is generating considerable positive cash from its operations. Additionally, page 42 highlights net cash inflows from operating activities amounting to RMB 28,682 million, underscoring the company's ability to manage its finances effectively. Lastly, on page 49, it is explicitly stated that the operating cash flow is positive, providing conclusive evidence of the company's financial health. In conclusion, the overwhelming evidence suggests that the company is indeed generating positive operating cash flow, a crucial indicator of its financial stability and success. The company's debt level has seen a significant increase in the past year. Total liabilities have risen by $14.5 billion, representing a 6% growth from 2024 to 2025. This is further reflected in the increase of bank borrowings from RMB 20,121 million to RMB 35,303 million. However, despite the rise in debt, interest expenses have actually decreased. In 2025, interest expenses stood at RMB 3,628,593,475.52, down from RMB 3,854,441,561.78 in 2024. This indicates that while the company's debt level has increased, it is managing its interest payments more efficiently. The performance of various segments and regions within a company has been analyzed based on extracted summaries. The agricultural segment stood out as one of the top performers, generating a significant revenue of $91.13 billion. The automobile and automobile components segment also performed well, with a substantial revenue of $64.02 billion. Additionally, the intelligent equipment segment showed impressive results, boasting both high revenue and profit figures at $61.84 billion and $17.11 billion respectively. On the other hand, certain segments struggled to meet expectations. The intelligent logistics segment experienced significant intersegment sales losses of -$13.32 billion, while the intersegment elimination segment also suffered from similar issues. Furthermore, the automobile engines segment underperformed, with revenue and profit figures at $59.41 billion and $10.39 billion respectively. These results indicate that some segments are thriving, while others require improvement to meet company goals. Management is outlining a clear vision for the company's future. The key takeaway is that the company will be accelerating its efforts in intelligent manufacturing, aiming to drive the industry towards high-end, intelligent, and green development. This strategic shift is expected to strengthen the company's competitive edge through breakthroughs in development. To support this ambitious plan, management is also emphasizing the importance of bolstering the company's capital capabilities. By doing so, they aim to provide a solid foundation for expansion and growth. Overall, the message from management is one of optimism and confidence in the company's ability to innovate and adapt to changing market conditions. The company has a history of paying dividends to its shareholders. In recent years, the proposed final dividend per ordinary share has increased from RMB 0.347 in 2023 to RMB 0.374 in 2024. This indicates that the company is committed to returning value to its investors through regular dividend payments. In addition to the increase in dividend amount, the company also provides a clear and straightforward calculation for shareholders to determine their cash dividend entitlement. For every 10 shares held, shareholders can expect to receive RMB 3.74, including tax, as a cash dividend. This transparency is reassuring for investors who value predictability and stability in their returns. It's worth noting that there is no information available on the company engaging in share buybacks. While this may not be a significant concern for all investors, it suggests that the company is prioritizing dividend payments over other forms of shareholder return. Concerns about inventory buildup and supply chain disruption exist in certain areas. There are valid concerns regarding inventory buildup or supply chain disruption in specific sectors. On page 11, the loss of impairment of inventories is a significant concern. Similarly, on page 12, depreciation and amortization, as well as capital expenditure, pose risks to the supply chain. Furthermore, page 21 highlights potential inventory buildup in agricultural equipment and intelligent logistics. These areas require careful management to prevent disruptions. In contrast, pages 2, 13, 20, 30, 34, and 38 do not raise significant concerns about inventory buildup or supply chain disruption. That concludes the financial summary for WEICHAI Power Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.